Thank you very much for joining us tonight. Obviously, a bit of an interesting topic. I hope you'll learn. I hope there's a lot of questions at the end. You would have noticed that it is part of the Under the Microscope series. If you probably have joined us previously for these Under the Microscope topics, and very much we focus in on interesting concepts. We've had quite a few structured products that we've discussed during the time we've ran these. We also did the US small cap one that I can remember right now off the top of my head. So very much in that vein, John T will chat you through the mechanics of the product. And I think you'll find it very insightful, and then we'll switch over and take some questions, hopefully. So just to position John T, he is with Jaltech. He's one of the partners at Jaltech. Jaltech very much focused, if you don't know them, very much focused on boutique alternative investments. Roughly about 1.7 billion assets under management. They've been in operations for 11 years, so roughly 2012 they started, and what they do very well. Of course, John T himself, is a practice. Well, he was a practicing attorney. He's an admitted attorney is probably the right word. Worked at ENS Africa, etc. I'm sure you read his bio as well. So very accomplished, and I think you'll enjoy him presenting tonight. So, John T, I think let me give it over to you from here. You're welcome to just introduce yourself and start with the presentation.
Great, Jaco, thank you very much. And thank you everyone for joining. Thursday night, really pleasantly surprised to see how many people are joining us. So that's really great. And thanks for having me. The topic for today, and you may have seen some of the news headlines and some of the articles, it's around Section 12B of the Income Tax Act. For those of you who may have heard or even have invested in Section 12J, that was an investment available. It ended in 2021 in June. And similar to Section 12J, Section 12B is an investment opportunity for taxpayers who, on investing, are entitled to a tax deduction. This specific investment or Section 12B investments are only in the solar renewable sector. Recently, in February, when the finance minister presented, the finance minister announced an enhancement to the incentive, increasing how deductible it is from 100% to 125%. And I'll explain what that means in a moment. But really, what it means is government is trying to encourage the private sector, surprise, surprise, to fund the renewable energy sector or the solar sector. And as a result, private capital is now going to be channeled into rooftop solar, and investors or backers of these type of installations now receive a tax benefit, which is, I think, extremely appealing. From a questions perspective, if I could ask, if you could type your question in, we'll then go through the questions at the end. Given the amount of people, it's difficult to allow everyone to have a voice. We might be here till much later. So type a question. If you're too shy or you're not quick enough to type, my details will be made available, or you can ask Jaco or Gary or the rest of the team, and they'll be sure to assist you. But let me kick off. So many people, or a number of people, when they hear Section 12B, they assume that Section 12B only relates to companies. Now, Section 12B is very popular amongst companies that invest in solar, but it's not just limited to companies. Because what the legislation says is, where a taxpayer, so an individual, a company, or a trust invests or purchases solar equipment, but with the intention of generating an income, in other words, for their business, or generating income from the sale of electricity, that taxpayer can claim a tax deduction. Now, the tax deduction is obviously very alluring. It shouldn't be the only reason you invest, and I'll take you through the returns in the investment. But I raise it in the beginning because if you don't have a tax problem, in other words, if you don't have a income tax liability. That could be from your income or bonuses that you earn in the year, or if you don't have a capital gains tax liability. And capital gains tax could be from a restructure of your portfolio, a sale of property, a sale of a building, etc. If you don't have those tax problem, it's a nice problem to have. If you don't have it, then this investment is most likely not for you. This is tax-led because the tax benefit is really, really significant, specifically in this investment. So if you look at the middle column, here we have a high income earner. This person earns 5 million Rand a year. They don't invest into Section 12B. And you'll see in the third last line, their taxable income remains 5 million and they pay around over 2 million Rand in tax. The same person on the far right column decides to invest 1 million Rand into this investment. But because the legislation now says it's 125% deductible, they can reduce their taxable income by 1.250. This results in the 5 million being reduced to 3.75. They're paying now only 1.5 million Rand in tax. But now they either receive a refund, literally SARS will write a check to the investor, or they receive either refund or their tax bill is reduced immediately. So if you're a provisional taxpayer and you invest today in August, you will pay 562,000 Rand less in tax if you're in the highest tax bracket. 562,000 Rand is a lot of money. You're investing 1 million, you're getting 56% back from SARS. Putting your investor's hat on, 56% back on an investment that you make, you receive it in year one. So you de-risked as an investor by 56%, which is really, really large sum of money. Now, when it comes to the structure, what happens is when you invest, and in some cases, you'd invest into a company and become a shareholder. In this structure, you're investing into a partnership, which is the identical structure you would have when you're investing into a normal private equity fund. You invest into a partnership. It's a limited liability partnership. Your capital is pooled along with other partners. And when the fund closes, the general partner, being Jaltech, will then invest the money. And how we invest the money is we are approached by solar operators. We have an extensive network and relationship with solar operators in South Africa. These solar operators bring us clients. We then review the clients to determine whether they are creditworthy, whether they can honor their obligation to us. And these clients are typically property holding companies. And I'll give you a few examples of the ones we're dealing with. And these are large, either commercial businesses, could be a retail shopping mall. And what they want is uninterrupted electricity. Once we've done our due diligence, if we're comfortable with a business, we'll then approve a payment. The solar operator, on behalf of the partnership, will go and buy solar equipment and install, operate, and maintain the equipment throughout the term. And the partnership will enter into a commercial relationship with the customer and sell electricity to the customer and earn income from the sale of electricity. The partnership throughout the term of the investment is the owner of the assets. And there are lots of benefits, particularly if there's a default, but the partnership has to be the owner. And this allows the Section 12B benefit to be passed on to the investor. Now, as a fund manager, we are only looking at investing into solar equipment, which will be installed on commercial and industrial buildings, not on residential homes, for a number of reasons. Commercial property owners would require an investment of between 5 and 25 million Rand, a residential homeowner between 250 and 500,000 Rand. So we would rather be managing 5 or 7 commercial property installations versus 100 residential homes. The second and probably the most important reason is commercial property owners generally consume electricity in the day. This means that the main components that we would be purchasing is solar panels and inverters. Because they won't be consuming much electricity at night, the battery component of this investment would be much lower than a residential home in proportion. And why this is important is batteries don't have a long lifespan. They can have a lifespan up to 8 or 10 years, depending on how many cycles the battery's taken. But the inverter and the solar panels can last between 12 to 20 years. And I'll get more into that in a couple of minutes. So the investment we'll be making is in the corporate space. A enhancement to this investment, which has really, in my view, makes this almost a no-brainer, is the fact that in the second year of your investment, we will be raising debt funding from local banks in South Africa, and we already have these discussions underway, and we'll be raising debt in the investment, but only to a maximum of 34% of the size of the fund. Now, the reason why we're doing this is because we will use the debt funding to buy additional solar equipment. By purchasing additional solar equipment, this allows our investors to get another tax benefit because the fund will own more, and as a result, an additional tax benefit is then permitted in the hands of the investor. For those of you, sorry, who've arrived a bit late, questions, if you have any questions, please type them in the Q&A section. I'll get to them at the end. Alternatively, chat to Yaku or Gary or the rest of the team tomorrow, and they can send the questions to me, or we can have a one-on-one during the course of next week. So back to the funding. So now we've gone and we've raised funding, and I want to run you through the numbers why this is appealing. So if you have a look at in the table on the far left-hand column, investor invests $1 million. This investor is in the highest tax bracket, receives a refund of 562,000 Rand. From the date that we've invested the capital, the investor will earn a return. And in the first year, that we look to return 135,000 Rand to the investor. In the second year is when we raise the debt. This will allow this investor to receive another refund of 290,000 Rand, plus cash flows that we've generated in the second year. And if we add up all these cash flows and we minus tax, because the cash inflows are taxable, the investor will receive the original investment value back at the end of year 2. From an investment perspective, you're now de-risked. Your original investment has now been returned to you in the form of cash flows and refund, but you'll still have R1 million in this investment, and you'll still be generating a return of R1 million. I see that there are already questions coming in, so if you've got any questions, feel free to put them down. Now to the cash flows. Now, there are a number of assumptions which I'd like just to run you through. These cash flows or the investment returns assume the investor is in the highest tax bracket. We assume that the prime rate, which is currently at, remains the same. This is relevant because when we sell electricity, we link it to prime. If prime goes down by 1%, it has a slight effect. I almost want to say immaterial, has a slight effect on these returns. Basically, the first year's cash flows, as an example, will go down by 5,000 Rand. The second assumption we make, and I'll go into more detail, is we assume that at the end of the investment term, we sell the asset back to the customer at 20% of its value, which is really low. And we also assume that we raise some debt funding in the second year, which we think is the likelihood is extremely high. So the cash flows, the first 4 lines I took you through on the previous slide. Investor invests $1 million, gets 562,000 Rand back. They receive their first year of cash flows. In the second year, debt's raised, they receive another refund. And in the second year, again, they receive cash flows. And now they're de-risked. All sums from year 3 onwards, these sums are already profit in the hands of the investor, but they are taxed, and they're taxed at the investor's marginal tax rate. So they're taxed as income tax. In the final year, we then assume we sell the asset to the end customer. We think that assumption of 20% is really low, but we're hoping to achieve much more. And we are really confident that we'll be able to sell the asset because the energy cost to the consumer at year 10 is very similar to, or it's not far off of the value of the asset. And from the consumer's perspective, majority of the assets will be solar and inverter, which have a 12 to 20 year lifespan. They'll be buying it in year 10 at a really good price. They will then be really pretty certain that that for the next 2 or maybe 4 or 5 years, they'll be able to enjoy electricity at a really marginal cost to them. So if you add up all these cash flows, they amount to 2.5 million rand. If you minus tax with a tax benefit, and all these amounts are after fees, the investor walks away with 1.5 million rand. Now, from a return perspective, your internal rate of return on this investment is 24%. A common question is, what happens if you don't sell the asset at 20% of its value? Well, the 24% will then go to 22%. So not a really material impact on the returns. And these slides will be made available, and this presentation is recorded, so you'll be able to, in your own time, go through this presentation. Now, when you see an internal rate of 24%, red flags should appear, and you should be asking yourself, what type of risk is Jaltech taking to generate such high returns? And I'm going to argue now that the return or risk profile of this investment is really low for the following reasons. Firstly, we aim to return 100% of your investment within 2 years through the refund and some cash flows. Every year you're receiving annual cash flows. They're paid out to you into your bank account. So therefore, every year you're de-risked because you're receiving more and more capital back. The underlying asset or investment is a physical asset. It doesn't implode. It doesn't disappear. If there's a default on a property owner, we can collect the asset. We own the asset. For sure, there'll be a loss. There's a cost of installation. There's a cost of wiring, etc. There will be a loss. We'll have recourse, and we could decide to sue the end customer if we want to, but there will be a loss, but we'll still retain majority of the value of the investment, which we can then go and either sell or we can install it somewhere else. And then fourthly, there's a known credit risk here. The end customer is a company that we've done an extensive due diligence on. We understand the financials in their business, we understand their balance sheet, and we understand how much energy they consume and whether they've been paying back or honoring their obligations to Eskom. With all this information in hand, we're already able to make an informed decision when investing into solar assets for a specific customer. So I think if you add these together, it really reduces the risk profile of this investment. But it's not without risk. This investment does have risk. And I'd like to highlight 3 main risks in this investment. The first is credit risk. So we really, as a fund manager, have to have a good understanding of the businesses we're providing energy to. I mentioned earlier, we manage over 500 million rand just in private debt funds. So we invest in businesses with private debt. So we really understand this market. We understand how to evaluate these type of people, all these type of businesses. So in the 1.7 billion rand that we manage, 500 million plus is in private debt. The second risk that you have is deployment risk. Now, if our fund target raise, which will be closing early June, is 100 million rand. If we only invest 50 million rand before the end of February, our investors will only be entitled to half of the tax benefit. So there's a responsibility on us as a fund manager to invest the capital. We've already secured a pipeline. We've already built up a pipeline of over 211 million rand. I'll take you through it in a moment. And we are really comfortable that our pipeline will be able to absorb the full 100 million rand. We think we'll have way excess of that. So what we're saying for our first tranche of investors, by investing with us now, the likelihood of us not deploying is extremely unlikely. We will be raising a second fund from the 1st of September. It'll be a 50 million rand fund. So if you aren't able to make this fund, we will have another fund available on the 1st of September. The second risk is debt funding. When you introduce debt into any investment, there is risk. What happens if one or all of the businesses that we provide equipment to, or solar renewable energy to, what happens if they all default? Well, the banks will have recourse against the assets and they'll be able to recover what they've lost. But in this investment, we have limited the debt to equity ratio to 2 to 1. In other words, for every 2 Rand of assets that we own, we'll only have 1 Rand of debt. So the physical assets that we own will be more than the debt that we've secured. So I think from an investor's perspective, there's much lower risk here by introducing debt. And just remember that by the end of year 2, the debt has facilitated the return of the remaining portion of your capital. So this is just some insight into the businesses that we are providing electricity to. We weren't able to disclose these businesses for confidentiality purposes, and because we haven't closed our fund yet. Once we've made the capital available and we've secured the transactions, we'll then be able to disclose. The first business is a REIT. It's a large property holding company. The initial tranche is 6 million Rand. We've signed the term sheet, and most likely this will grow to 50 million Rand over time. We're dealing with a listed company. They want to do a solar installation on their head office, around 15 million Rand. We have got 2 asset rental companies that are looking for 40 and 30 million Rand each. We've got a large financial institution. It's a known brand. You know them, you'll know them very well. They're looking for around 20 million Rand. We've got a residential property holding company. So this is a really large property holding company. They have 3 really large residential buildings. They want to install solar and sell electricity to the residents. We don't take residential exposure. We're taking property holding company exposure, and this property holding company is huge and it's got a massive balance sheet. So we're not worried about the credit risk. We've got an end customer at the Richards Bay terminal. Their initial requirement is 10 million Rand, and the opportunity there is extensive. And then we've got 2 solar operators. They've got end customers who want to buy electricity. We're going to provide them with the equipment. They're going to manage it and sell electricity to their end customers. And as you can see in the far right-hand column, we've got 1 signed deal. We've got 4 that are really in the final rounds of negotiations. We're quite confident that we'll close these, and we have a couple in negotiations. And these add up to 211 million Rand. But we've got a really large team that are in the market day in and day out looking for transactions. As a fund manager, we want to raise more than 100 million Rand this year. We want to raise around 350 million Rand. So we are really trying to build the biggest pipeline that we can so that we have options in terms of which are the best businesses that we can provide solar to. Some of you might say, whoa, this is a 10-year investment. Do I really want to be exposed to South Africa for 10 years? And my argument would be that this investment is a hedge against the demise or decline of the South African economy for 2 reasons. One is the energy consumers that we are supplying electricity to, they want uninterrupted electricity. So if load shedding continues, they're incentivized to continue to pay us because they want uninterrupted electricity. But let's assume in 2 years' time, load shedding is a thing of the past, which I think is extremely unlikely. The rate that we sell electricity to these customers in the years to come will be much, much cheaper than the Eskom's rates. So these end customers are incentivized to pass. Or if they default and we turn off the electricity, then they'll have to be paying a much higher tariff to Eskom. So given these 2 factors, I think even though the SA economy may keep going down over time, this investment is a hedge against the SA economy. I'm not going to go into too much detail here, but if you are a Section 12J investor, if you are coming to the end of your investment term and you exit your Section 12J investment, this is a great option by moving your Section 12J funds into this fund, because it'll help you cushion the capital gains tax liability you have when exiting a Section 12J fund. If you are in this scenario, this is a discussion for another day, but it's a really, really good option. In summary, in terms of the investment, our minimum is 250,000 Rand. It is a 10-year investment. You are exited around the 2-year mark. You are exited through distributions and the refund that you receive from SARS. The underlying investment is asset-backed. Your return as a high-income earner is 24%, which includes the tax benefit. It's after fees and taxes. We're looking to return 100% of investors' capital within 24 months. We've capped our fund at 100 million Rand. And if you are interested in investing, you would need to fill out a commitment form and deposit 5% before the first week of June. An update in terms of where we are. We have got, of the 100 million, already 52% secured. So investors have signed commitment forms. Of that 52% is myself and my partners. We're investing around 6 million rand between the three of us. And the balance is available. However, we have allocated around 25 million rand to a number of financial advisors that we work with, but it's not exclusive to them, but we anticipate they'll take that and more. So I would imagine that in the market, we have around 20 million rand available to invest. If the time frames are too short for you, no problem. From the 1st of September, we most likely are going to launch our second fund. It will only be 50 million rand. From a fee perspective, we charge an annual fee of 2.25%, and we charge a performance fee of 20%, which is effectively above a hurdle of 10% with a high watermark and catch up. And what that means is we'll only earn a performance fee if we return above 10%, if we return each year. If we return below 10%, the following year, we need to catch up the difference in order for us to earn a performance fee. Everyone, thank you very much for your time. And I see there are a couple of questions, Jaco.
Thank you, Jonty. We'll have a look at the questions now. If I may, can we just drill into 2 or 3 concepts slightly deeper? So just if you could just bring up the presentation again, the slide where you have the 10-year cash flow projections. I just want us to just spend a minute or two on 1 or 2 concepts, just to make sure everybody understands. The first one is obviously the investor is in the highest tax bracket, so as close to 45% as you can get. We just need to unpack that a little bit. So those 2 numbers, the 2 SARS refunds, line 1 and 3, 562 and 289, they are based on a 45% tax bracket. However, if you are in a tax bracket slightly, I don't know if you could hear that. The heavens just open on my side. If you are in that tax bracket, or in a lower tax bracket at least, those numbers look a little bit different. So this kind of de-risk period that Jonty was talking about, of roughly 2 years, that changes if you have a lower marginal tax rate. So if you're not in the highest tax bracket, and at about, I think we looked at it at about 36%, you're kind of adding on a year before you kind of completely de-risk, at least in this definition of de-risk. Happy with that comment, Jonty?
Yeah, no, absolutely.
Okay.
Absolutely. Yeah.
Great. So that's the one thing that I think clients just need to keep in mind. The second one is obviously prime rate. So we know from a prime rate perspective that at the moment we're kind of on the higher side of it. How quick we come back down is obviously a hotly debated topic. But it is a risk, probably a small one, but maybe a risk just to kind of unpack slightly. So Jonty mentioned that the end customers are obviously linked to the prime rate, so it will be prime plus something. And if there's a 50 basis point reduction in the prime rate, then it's going to be a 3, 4, 5% impact on these cash flows. So each line item here that you see, there's a pre-tax income. You will see that, let's say 130 or 140,000 rand, that will drop by, let's say 3, 4, or 5% for every 0.5%. And if it's 2, 3%, then it can drop as much as 10, 15%. So it is just, it's not really a risk. It's just the income will remain. You will still get it in. It's just to understand that there is, it can be a little bit lower from that perspective if the prime rate obviously changes. Anything you need to add to that, Jonty, or happy with the comment?
No, you're absolutely right. I think it's foreseeable that maybe in the next 2 years, prime may start coming down. So, investors need to be mindful that these cash flows aren't guaranteed. But the nice thing is, once we've secured the contracts, the cash flows, albeit not guaranteed, they're very consistent and predictable. So as long as we've provided a solution or energy solution to end customers who are very creditworthy, these returns become very predictable. But again, they are linked to prime, which may fluctuate the returns.
Perfect. The next one just is a very quick one. Obviously, you carry a risk, and you spoke about the risk on the end customer, as you alluded to now as well. How many end customers? So you're diversifying your risk, because you're not just going to one end customer. So what do you envisage? How many end customers will you be dealing with in this?
In the first tranche of 100 million, around 5 to 7 end customers. So there is really nice diversification. We also have, within our mandate, we're not allowed to provide any single opportunity with more than 25% of our funds, and we're not allowed to provide any group with more than 40% of our funds. So, that mandate forces us to diversify exposure.
Good. Thank you. And then from my side, just the last thing is what you've already touched on, but I thought let's just unpack it slightly deeper or more, is the deployment risk. So in terms of a deployment risk, the rule is, and Jonty, help me if I don't have the correct wording, but the rule is the end customer, there needs to be a production of electricity from the end customer or to the end customer by the 28th of February next year. So it needs to be installed, and they have to already receive that amount that they were kind of promised for a client at least to have the whole amount applicable as you showed it. Does that sound correct?
No, that's spot on. So it takes between 60 and 90 days from initial construction to the production of electricity. So we know as a business, by the end of October, we need to be fully deployed. That gives us more than the 90 days we need for the electricity to be in production. But we anticipate around at the end of August to be fully deployed, which will give us ample time. If there's a supply shortage, which there isn't at the moment, if there's a construction issue, it gives us a lot of buffer to generate electricity. And as I mentioned earlier, I'm a significant investor in the fund. So are my partners. We incentivize really to fund great businesses and deploy the capital within time. Otherwise, not only will our investors not get their refund, and neither will I. So we're very much incentivized to make sure this investment works.
Absolutely. Thanks. All right. Let's jump to some questions. I think the first one you've already answered, but let's just mention again. The minimum investment size for this tranche or vintage is 250,000 Rand. That's the first one. Then, Jonty, what happens if the client dies during the 10-year period?
So the asset will fall within the client's estate, and a beneficiary could be the heir, or an heir could receive the asset and enjoy the income. So it falls within the estate. What we've done in the past with similar investments is we've tried to accommodate the family. So there's no guarantees that we will do this. We're human beings with a conscience, so we'll try and do this. But again, no guarantees. What we would look to do is say to the estate, these are the predictable cash flows for the remaining term of the investment. We'll do a discounted value of those cash flows, and then offer the estate a sum of money to exit the estate from the investment, and the estate can decide whether they want to accept it or not. If they don't, well, then the beneficiaries or the heirs will just receive the income for the remaining term of the investment.
Good. The next one, I think it's a reference to the high water mark. Is the 10% calculated on risk capital or initial amount invested?
It's a great question. So, and I just want to unpack this question. So what historically happened in the Section 12J days is you'd invest 100 Rand, you'd receive a refund from SARS of 45 Rand, and you would have had risk capital of 55 Rand. And what fund managers would do is they would charge a performance fee on anything above the 55 Rand. In other words, they would charge a performance fee on the SARS return. We didn't do that in 12J days, and we won't do it today. And I can promise you now, we'll never do it. Our benchmark or our watermark is above the original investment amount. You invest 100 Rand with us, and in the example I gave, it has to grow to 110, and only above the 110 do we charge a performance fee. But that's measured every year. So in year one, if we only return 105 Rand, we don't earn a performance fee. The following year, we need to return 115 Rand. Sorry, 115 Rand before we're even eligible for a performance fee. And that really keeps the fund manager in check. Every year they need to perform or they don't earn a fee.
Perfect. I hope that answers the question. The next one, and we knew it would come through. Do the panels need to be replaced during the 10-year investment? And will that affect the returns?
Well, I hope they don't have to be replaced. So the panels that we have experience with, and in particular Canadian solar, and most panels have a life expectancy of anywhere between 15 years and 20 years. Technically, what happens is in the first year, a panel loses 2.5% of its energy production capacity, and then every year thereafter, only 0.5%. So the life expectancy is 15 to 20 years plus, but you'll remember our investment is 10 years. So we want the end consumer to be comfortable that the panels have a life expectancy, because we want them to buy the panels from us to create liquidity and allow us to give our investors a nice balloon payment at the end. So no, most certainly not. If they don't last 10 years, we've done a terrible job.
Thank you. The performance fees, have you already factored them into that timeline? Sorry, not timeline.
The return
return calculation.
All the returns that we demonstrate are after all fees. So after our annual fee and after performance fees, there are no other hidden costs. We've got no interest in energy producers. We're not making money on the side or any other way. We're not getting rebates from suppliers. Those are our fees. And yes, the returns are net of fees.
Okay, good. All right. If there are any other questions, you are welcome to email myself. You can reach me on yaku@randswiss.com or the normal info, or even events, whichever email you have, and we're happy to chat you through it. Obviously, Jonty is available as he mentioned. So let us know if there are any further questions, but I don't see any on the call, Jonty. So I would like to thank you very much. It's great to have a guy like you on a Thursday night, and really appreciate your time and effort. And let's hope this is wildly successful, and keep on doing the good work you do.
Thank you very much. Thank you. And it's been great. And for everyone else who's joined, appreciate your time.